And then the way to create wealth in Canada, one is probably starting your own business, right? But second would be through real estate. Welcome back to another episode of the TF Team podcast. And yes, again, 2 weeks in a row, I'm looking around and no Josh again. But once again, Kevin is here. There was so much to talk about last week, Kevin, about mortgages. We got a lot of feedback about the process that you've talked about, and hoping to get a bit more feedback again today based on what we're going to talk about, which is we've got the process down. I've given you everything. You know everything there is to know about me. What next? Where do we go from here, Kevin?
Yeah, so you've done your job. It's time for me to do mine now,
Okay.
right? So the reality is, you've given me all the docs. I have a picture. I understand what your situation is, whether it's you're working for somebody or your business for self. We're gonna have to look for the lender now, right? The different type of lender that's there. So we're gonna make it very simple, right? I'm gonna break it down to the A lender side, the B lender side. And I want to give everyone fair warning in advance. B is not bad. I know we're used to getting like A's are great. What did you get on your math test? A.
Yeah.
B is not bad.
Yeah.
Okay. B lenders, they have what's called common sense lending policies. They use more of a realistic approach as well. They have to be compensated for that level of risk though. So they have their own fee as well. They may have a little bit of a higher rate, but it's not overly crazy.
It's not 10%.
No, it's not. But what I would say that with that being said though, we always start off on the A side first until we exhaust that option. And the A side would be, the blenders and the banks you're used to hearing about, like TD, Scotia, BMO,
Big Five, yeah.
right? So we exhaust that option out first. Once we know we cannot, then we start heading into B territory.
Yeah.
And B territory is not like I said, overly expensive or anything like that. People always look at cost. I always tell people, what are you getting? Right? Look at what you're getting, not what you're paying. Value. So I'll give you guys a really great case study, right? I had a great client of mine. He works in construction. He does taping and mudding.
Oh,
right?
yeah.
So he makes really great money, right? He is business for self. He is an independent contractor. Construction companies that need his work will hire him specifically, so he gets checked, no problem. But he takes on side gigs as well. We talked about the gig economy, right?
That's right.
So he takes on side gigs after his work hours. So some of it, is cash. A lot of them are like his regular business hours, all checks from like big reputable companies as well. So he's not a person that's going to get a T4. I can't ask him for a T4, right? He's a sole prop. He doesn't have a corporation. So if what do I bring to like TD Bank or Scotia Bank? What do I bring to them? Their requirements are this, and this.
Yeah, they're pretty strict in terms of what they want. The big five.
But with 12 months bank statements, I'm able to get him qualified with a B lender, right? That is also like a very large trust company as well, right? They're big, they're huge. And and we got him into a property and his family into a property. And then basically they're in between like different cities, so they decided to rent out that property, right? So they don't want to live there because they're like, they realize the commute's a little bit excessive, no problem. Or maybe like more of his clients are somewhere else in the city now. So he's like, just for convenience, not really interested in commuting right now. We're gonna rent it out. They got a great tenant. Think about it this logically though. The opportunity cost of not having that property now. Because I was so stuck on paying this rate. I was so stuck on that.
At this bank and so on.
I want this bank. Well, let's be realistic here. He's getting equity pay down. He has the option, as if he needs to, like move into his home later down the line. And his mortgages right now is being paid down, right?
Exactly.
And also he got into the market where at the time the prices were like a little bit because the rates were high. Home prices at that time were a little bit lower, softened up a bit too. I always tell people it's not what you're paying, it's what you're getting.
Yeah.
Right?
Excellent.
When you go pay when you go study, you're taking out OSAP,
Mm-hmm.
right? And no one's ever saying like, "Oh, what like, oh, I don't want to be in debt."
Mm-hmm.
Because they look at what's on the other side,
That's right.
which is
The
education,
opportunity. Yeah.
right?
Mm-hmm.
And
Mm-hmm.
what about and the opportunity, like sorry to cut you off, opportunity of
Mm-hmm.
future growth, future
Mm-hmm.
income,
Mm-hmm.
right? So the same thing here. There you cannot put a price
No.
on getting into a rental property or
Mm-hmm.
getting into your own owner occupied property. It's
Mm-hmm.
just, there's nothing else that could replace it, really.
Bang on. I mean, you and I are kind of similar in terms of what we do. And this is what I'm getting is that clients coming to you, they give you their picture, and then you assess the best product, the best solution for them. And you have a wide network of potential solutions. So kind of similar to on the financial planning side, clients tell us their goals, their dreams, and their aspiration, and then we'll create a plan, and the plan will incorporate all types of solutions, not just from TD, not just from Scotia. It's from all over, and we find the one that meets the client's particular solution.
Yeah.
So by having that picture painted, you're best suited to know exactly kind of where to go. So forget the labels like
B.
A and B, or even C. The goal should be right now to get into the market. And
Yeah.
then once you get in the market, let's say you've got bad credit. Maybe we could work with you and also work with our team to better your credit so that the next house that we go to,
Yeah.
if
Graduate into the A one day, right?
exactly,
But
exactly.
I also have to say, right, in general,
Mhm,
like whatever you think in your mind as a
mhm,
lending policy on the B side,
mhm,
it makes sense. Like
mhm,
I'll give you guys a really good example, right?
mhm,
Like when you were going on the A side, when you have too many properties,
mhm,
what ends up happening is that a lot of the rental offsets, right?
mhm,
We're talking about like rental properties here
mhm, mhm,
specifically. So the rental offset on the A side, for the
mhm,
most part, is a lot lower. Like
mhm,
we'll just make it like round and easy, 50%, which is common.
mhm,
The
mhm.
rental right offsets, but on the B side, it can go up to like 90%, right?
Yeah,
Or like even higher, maybe potentially, depending on which lender.
yeah.
But 90 is like 80 to 90 is like a safe like zone.
So, because I know our clients are kind of basic in terms of the terminologies. You and
Oh
I,
yeah.
I get. I guess with the rental offset is that what percentage of the income that your renters are paying could you use? Because a lot of people will
Yeah.
say, I'm living upstairs. My tenant is in the basement and paying me $1,000. So that's $12,000 a year. So when I'm going to show that to a lender, 12,000 as income that I'm receiving. If you go to a typical A lender, if you go to the RBCs, the TDs of our world, they're not going to use the whole 12,000. They're only going to use, like you said, 50, maybe 50% of
Yeah.
50% of that. Well, you have access to other lenders that could, go up to 80 to
Yeah.
90%, right?
But yeah, and they view that as common sense because it makes
Mm-hmm.
sense.
Mm-hmm.
But they also need to be compensated for that risk evaluation as well.
Mm-hmm.
For
Mm-hmm.
that, because there's more risk that is involved.
Mm-hmm.
So I would say, like, if we're starting out and
Mm-hmm.
you're brand new, it's
Mm-hmm.
very likely if your income makes sense, you
Mm-hmm.
have good credit,
Mm-hmm.
very, very, very probable, highly
Mm-hmm.
probable will end up at on the A side,
Mm-hmm.
right? It's when things get a little bit more complicated with your credit,
Mhm,
how your income, where it
mhm,
comes from, the source of income,
mhm,
and then and how much more debt you have
mhm,
because the rental income
mhm,
side, like the rental properties that you have,
mhm,
or let's say you once you get there, but let's say you have other debts, your ratios or how much utilization you've had impacts, so you
mhm.
might not be in a position to be in the A side.
Yeah.
But we got to have a diagnostic first. I know it like I know it sounds kind of crazy,
Mhm,
but I would say this though. People always have misconceptions about intentions.
mhm,
My intention is to get you into the A first, and if
mhm.
I cannot, we'll have that dialogue, right?
Yeah.
And to be fair, if you need a second, third, fourth, fifth opinion, that's no problem too. Just like, when you go see a doctor, may
Mhm,
not trust them. You might want to opt out of that dangerous or serious
mhm,
surgery, right?
mhm,
You're gonna want to go and get opinions. I encourage everyone to get opinions because I know,
mhm,
my intentions are there. I
mhm,
know that I really want you in the A first, and
mhm.
if you can't, then we have to open up that dialogue after,
Yes, I
right?
I agree. And you know, at this juncture, the goal, the Canadian dream, or if Josh was there, it'll be the American dream, but is for home ownership. Get into that house
Yeah.
first, and then the way to create wealth in Canada, one is probably starting your own business, right? But second would be through real estate. Get that first house, and from the equity of that first house, this is where you're talking about in terms of rentals,
Yeah.
right? And if you're looking to get that second house, I think you got to go to Kevin to look at how we could leverage the first house, and look at the ability to maybe go to a B lender to start with, because they're a bit more flexible than the A side.
Just depends on the
Mm-hmm.
file, of course,
Mm-hmm.
but I think in closing, I think the most important thing you mentioned, you have to get into a property, but
Mm-hmm.
let's get into something you can afford,
Oh man, that's
right?
so true.
And
Oh yeah.
it may not be the market you're thinking of
Mm-hmm.
right now at this second,
Mm-hmm.
but I've always been a big believer that
Mm-hmm.
there's something out there. You just gotta look. We can always have that dialogue,
Yep.
and you can reach out to us anytime. Like I always have calls with millennial Gen Z
Mm-hmm.
looking to get into the market. And I always ask them like what their goals and dreams are.
Mm-hmm.
Obviously, everyone wants that final home to
Yeah.
raise their family
Yeah.
and their kids in. Unfortunately, in our generation, though,
Mm-hmm.
it may not come as easily as past
Mm-hmm.
generations.
Mm-hmm.
So we need to come up with a game plan that makes sense,
It,
obviously,
it's
for
so
them.
funny. You're bang on. Don't look at what your friends are doing. Don't look at what influencers are doing. Look at yourself. What do you want to achieve? I remember, and maybe my role model was my mom. First house that we got was a semi. The second house after that, which is the house she still lives in, was a detached. So Pierre's first house, I won't tell you when, 1800s, it cost me $125,000 to buy a semi, early 90s, right? And from that semi, we moved into a detached house, right?
Yeah.
And then from there, we moved on cottage rentals and things of that nature. Don't worry
Yeah.
about what your friends or anybody else is doing. Worry about you. Get that first house.
It may be a little bit further away.
Exactly.
So just kind of like your example, Pierre, right?
Mm-hmm.
Semi,
Mm-hmm.
right? And then a single family. So I know people that started off in a condo
Yeah.
and then a townhome
Mm-hmm.
after, and then maybe now we might have to be a little bit further
Mm-hmm.
away,
Mm-hmm.
and then slowly kind of creep your way back into the city.
Mm-hmm.
It's all good. There's enough opportunity for everybody.
Mm-hmm.
It's just a matter of getting educated about it.
Yeah.
And we could definitely talk about it. I'm happy to. You know that. I could talk about this forever.
Definitely. And I love that. Now, the one last thing that I want to say, and that we really talked about process and A lenders and B lenders, but if your house is going to be the biggest purchase in your lifetime for most Canadians, you cannot buy a house without house insurance. So you should not buy a house without life insurance, because we need two incomes now to basically maintain our standard of living, to pay for the mortgage and the property taxes. What would happen if one of those income was to disappear, right? Then you're going to have to give up your dream of home ownership, because you needed two incomes and now you only have one. I'll end this in a positive but tragic note, in a way. Early 2000, early 2000, when I was working at the bank, I had a client, and husband and wife, and a little girl, and we did the pre-approval. We talked about that last week. Did a pre-approval, so told them exactly how much they could qualify. They went in and they bought within their means, right, on the low end, and we signed everything. The house is about to close 60 days. I made sure, I said, let's get life and mortgage life insurance, right? Because I was thinking of the husband because he was the main breadwinner. I said, what would happen should you die? What's going to happen to to your daughter and your wife? And he saw the value, because a lot of people think of it as an extra cost. They took the life insurance. The house didn't close. 60 days later, when that house was supposed to close, the wife passed away. The wife died, and it's already traumatic enough. The little daughter's going to grow up without her mommy. But to make things a bit easier, I mean, you can never recover from the loss of your mother, but to make one less thing for the husband to have to worry about, the house was fully paid off without making a mortgage payment. The house was paid off. So if you're going to buy a house, your biggest expense, you definitely need to have life insurance. And I would recommend that you get life insurance from an insurance company, not the creditor insurance that you get through your mortgage lender. I'm sorry, Kevin, but uh, get it from a life insurance company. And if you don't know anyone, I'll be more than happy to kind of point you in the right direction. The only reason I'm saying that is creditor insurance is decreasing insurance, right? So what does that mean? As you're paying down the mortgage, the amount that they'll pay off is going less and less, but your payments are staying the same. So let's say you bought a $600,000 house, right? And then 10 years later, the mortgage went down to about $400,000 and you pass away. Originally, you took it for 600. They're only going to pay 4, right? They're only going to pay what the mortgage balance is, even though your payments are based on 600. Now, if you get it through a life insurance company, they're going to pay you the 600,000, and chances are your mortgage insurance payments are going to be less than the creditor one that you would pay at the bank. So the house is worth the mortgage is 4, you get it to the life insurance company, we pay 6, we give you 6, you pay off the 4, and then your family keeps the remaining 200. That's my little bit piece. But peace of mind is so important, and I'm hoping that Kevin and I were able to give you that peace of mind, this 2 episode, through the process, and also about the mortgage lenders A and B. Now, Kevin, if people would want to get to reach out to you, how could they do so?
Yeah, so I'm always available. You can reach me through Instagram
Mm-hmm.
at Kevin Hoang Mortgages on Instagram, and I'll have my like contact info, phone number, emails, everything like that available
Mm-hmm.
as well.
Mm-hmm.
But in closing remarks, my biggest takeaway from you, and same takeaway that I always preach as well, is that it's not what you pay, it's what you get,
Mm-hmm.
because the cost,
Mm-hmm.
it could be much more detrimental,
Mm-hmm.
right? And
Mm-hmm.
if we don't, if we just only focus on our expenses and what we're
Mhm,
paying out,
mhm,
right?
mhm,
We,
mhm.
we kind of overlook things at that
Exactly.
stage,
Yeah.
right?
Well, I hope you found it informative. If you have any questions, please reach out to us. We'll be more than happy to answer any question. You know what? You know what I'm going to do? My director is probably not going to like this, but for the first 5 people that ask questions, I will provide you with 5 free financial plans, no questions asked. 5 free financial plans to the first 5 individuals. Don't tell Josh about this. This is only for you, for our audience right here. Well, once again, Kevin, thank you for joining us. Please subscribe and like, and please don't hesitate to reach out to the TF team or my good friend Kevin. Enjoy.